Good afternoon. Thank you for joining us for Trading ETFs in Volatile Markets, a one-hour webinar sponsored by Knight Trading. My name is Dave Nadig, and I'll be your host for today's webinar. For those of you who don't know me, I'm the Director of Research here at IndexUniverse.com, as well as the Journal of Indexes and the Exchange Traded Funds Report, the longest-running ETF-focused newsletter in the world. Today's webinar topic is nothing if not timely. The flash crash on May 6th was a stark reminder of two things. First, that ETFs are, as the name suggests, exchange-traded instruments above all else, and investors who ignore that can make potentially fatal errors. The second is that there is a definite difference between a good and a bad trade. It's not just a technicality. The quality of your trades, particularly in volatile markets, can have a very substantial impact on your returns. The format for today's webinar is simple. We'll start off by digging into the flash crash in detail, not because it's so newsworthy at this point, a month after, but because it's a great example of what can happen to ETFs in volatile markets. Next, we'll focus on what the flash crash teaches us about how to trade ETFs effectively in volatile markets. And along the way, we'll bust two of the biggest myths in ETF trading and liquidity and bring some sorely needed common sense to this area. After I make a short 25 or 30-minute presentation on some of the key issues, I'll bring in my panelists. First, today we have Reggie Browne, Managing Director of Listed Derivatives at Knight Equity Markets. Reggie is without a question one of the smartest guys in ETF trading, and Knight is the largest trader of ETFs in the world. His job is to help investors get better execution in ETFs, and he's a great resource for anyone looking to understand how ETFs really trade. Joining Reggie on our panel is Dave Morton, the Chief Research Officer and co-CIO at Foxhall Capital Management. They're an advisory firm based in Orange, Connecticut, and they use ETFs extensively as their investment vehicle of choice. Dave's also the editor of Advisor Guide, an online research publication for advisors. Before we get rolling, a couple of quick housekeeping items. As a participant in this webinar, you can submit questions for me or my panelists at any time during the presentation by entering them into the Q&A window on your screen. We'll collate the questions and answer as many as we can during the Q&A period. A replay of this presentation and a copy of the slides will be available at IndexUniverse.com within a few days, certainly by the end of the week. And for those of you who are viewing this live today on June 29th, information on how to apply for CE credits will be contained in a follow-up email. So with that, let's step back to May 6th and talk about the day of the flash crash. May 6th started out pretty much like any other day of the past few months. Investors were worried about fiscal trouble in Europe, like we have been for the last year. We had bad news that morning of riots in the Greek capital, and stocks mucked around at the open and began grinding slowly downward. In other words, it was a pretty normal day in these kinds of markets. And then all of a sudden around 2:30, many major U.S. stocks took an abrupt nosedive, and the major U.S. equity indexes lost about 10% of their value in just 5 minutes. The Dow fell nearly 1,000 points, and many individual securities started trading for less than a penny in ways that most investors just couldn't make any sense of. While some semblance of order was very quickly restored in just half an hour, the market had temporarily lost about $1 trillion in value. ETFs were far from immune. In fact, they were uniquely affected by this flash crash. All told, more than 300 securities suffered from broken trades that had to be canceled, and more than 2/3 of those were ETFs or exchange-traded notes. The RIDEX S&P Equal Weight ETF, or RSP, is kind of the one that I like to use as a case in point. RSP holds all of the stocks in the S&P 500 index equally weighted at 25 basis points each. So 25 basis points in Exxon, 25 basis points in Cisco, et cetera. And as you can see in this chart, the trouble for RSP happened extremely quickly, much more quickly than it looked like on that chart for the S&P 500. It was trading along fine at about $40 a share, right up through 245 on that day, and then wham, in the span of 36 seconds, over the course of just a few dozen trades, the price tumbled down to $29.87. And then the impossible happened. The very next trade was actually for a penny. And you can see those trades on here. You can't see those trades on here because, as we all know, the SEC stepped in and reversed a lot of those trades, the trades that fell outside a 60% loss window.